Imagine reaching an age where the law quietly opens the door to valuable tax breaks, property protections, and cost-saving programs. Yet almost nobody tells you they exist. Every year, countless Americans over 65 continue paying bills, fees, and taxes that could be reduced or, in some cases, significantly lowered. Not because they did anything wrong, not because they missed a payment, but because nobody ever informed them that eligibility and enrollment are two completely different things. The government doesn't automatically call, local agencies rarely send reminders, and most benefits only begin after a simple application is submitted. That gap between qualifying and claiming is where thousands of dollars disappear for many retirees every year. One of the biggest misconceptions is that these programs are only for people facing financial hardship. Others assume the exact opposite and think these benefits are reserved for wealthy homeowners with expensive accountants handling their affairs. The truth sits somewhere in the middle. Some programs are especially valuable for retirees living primarily on Social Security, while others can save substantial amounts for homeowners whose properties have increased significantly in value over the years. Regardless of income level, age alone can unlock opportunities that many people never realize are available. The most frustrating part is how invisible these missed savings can be. There is no warning letter, no penalty notice, no flashing alert. Money simply continues leaving bank accounts month after month and year after year. The result is that many hardworking retirees unknowingly spend far more than necessary on taxes, healthcare costs, and housing-related expenses. Let's begin with one of the newest tax benefits available to older Americans. Starting with the 2025 tax year, eligible taxpayers age 65 and older may qualify for an additional deduction of up to $6,000. This deduction is separate from and in addition to the standard deduction many taxpayers already claim. For married couples where both spouses qualify, that benefit can potentially double. What makes this deduction particularly important is that many taxpayers may never notice whether it was properly applied to their return. A simple data entry mistake involving a birth date can sometimes affect eligibility calculations. Tax software generally handles the process automatically when information is entered correctly, but reviewing the final return before filing remains a wise step. For many middle-income retirees, this deduction can lower taxable income and potentially reduce federal tax liability. Income limitations may apply, and eligibility rules can change over time, but the broader lesson remains the same. Even when tax laws are designed to help seniors, those benefits only matter if they are actually claimed. Another area where major savings may exist is property taxation. Property taxes often represent one of the largest recurring expenses for homeowners, especially retirees living on fixed incomes. Yet many counties and states offer programs specifically designed to reduce that burden for older residents. The first protection many homeowners should investigate is the homestead exemption. While the details vary by state, homestead exemptions generally reduce the taxable value of a primary residence. By lowering the assessed value used for tax calculations, homeowners may pay less property tax each year. A common mistake is assuming that homestead exemptions are automatically applied when a home is purchased. In many jurisdictions, homeowners must actively submit an application. Missing the filing deadline can mean paying higher taxes unnecessarily until the exemption is approved. For retirees, there is often a second layer of savings available. Many states provide additional senior exemptions that become available once a homeowner reaches a certain age, frequently age 65. These exemptions may further reduce taxable value and lower annual property tax obligations. What surprises many homeowners is that some senior exemptions are based primarily on age rather than financial need. People sometimes assume they earn too much to qualify and never bother checking. As a result, they continue paying larger tax bills than necessary despite meeting the requirements. Then there is the benefit that can become extremely valuable over time: property tax assessment freezes or tax ceilings. Depending on state and local laws, certain homeowners may be able to limit future increases in taxable assessments or property tax obligations once they reach qualifying age thresholds. This type of protection can become particularly important in areas where home values have risen dramatically. Imagine owning a house for decades while property values throughout the neighborhood continue climbing. Without protective programs, Rising assessments can lead to higher tax bills even when household income remains relatively unchanged. Assessment freezes help shield eligible homeowners from some of that pressure. For retirees who purchased homes many years ago, these programs can potentially preserve thousands of dollars over the long term. Yet they often require filing paperwork with local authorities. Without that step, the protection may never take effect. Even renters have a reason to care about property tax policies. Property owners frequently factor tax expenses into rental pricing decisions. While the relationship varies from market to market, lower property tax burdens can sometimes help reduce upward pressure on housing costs. Healthcare expenses represent another area where many retirees may be overlooking valuable assistance. One of the most common recurring deductions affecting retirees is the Medicare Part B premium. Because it is often deducted directly from Social Security benefits, many people barely notice it leaving their accounts each month. However, certain Medicare Savings Programs may help eligible individuals cover these costs. Depending on income and other factors, these programs can potentially pay Medicare premiums and, in some situations, reduce additional healthcare expenses as well. A major reason participation rates remain lower than expected is misunderstanding. Many retirees assume their income is too high or believe savings automatically disqualify them. Yet eligibility standards differ across programs and states, and some rules have changed over time. This is why a simple eligibility review can be worthwhile. A brief conversation with a qualified counselor or state assistance office may reveal benefits that were previously overlooked. For someone living on a fixed monthly income, reducing healthcare expenses can make a meaningful difference over the course of a year. Another healthcare-related benefit often connected to these programs involves prescription drug assistance. Medication costs can become a significant financial burden, especially for retirees managing multiple prescriptions. Certain assistance programs may help reduce premiums, deductibles, or out-of-pocket medication costs for qualifying individuals. The important takeaway is not that everyone will qualify for every benefit. Rather, it is that assumptions often prevent people from checking in the first place. Many retirees eliminate themselves before ever reviewing the actual requirements. That pattern repeats itself across nearly every program designed to assist older Americans. People assume they earn too much. Others assume they own too many assets. Some believe the paperwork will be overwhelming, and many simply do not know where to start. Meanwhile, the benefits remain available for those who take a few minutes to investigate. The reality is that financial security in retirement often depends less on finding new income and more on keeping more of the income already being received. Reducing taxes, lowering healthcare costs, and taking advantage of age-related protections can have the same practical effect as increasing monthly income. For example, saving $150 or $200 each month through a combination of tax reductions and healthcare assistance may not sound dramatic at first, but over the course of a year, those savings add up. Over multiple years, they can become substantial. And unlike temporary windfalls, these savings often continue year after year once properly established. The key lesson is simple. Eligibility alone does not create savings. Action creates savings. Whether the benefit involves tax deductions, property tax exemptions, healthcare assistance, or other programs, most opportunities require some form of application, verification, or annual review. Many retirees spend years assuming that if a benefit existed, someone would have told them about it. Unfortunately, that assumption can be expensive. Agencies generally administer programs. They do not typically search for every eligible person and personally notify them. That means the responsibility often falls on individuals and families to ask questions, verify eligibility, and ensure applications are submitted correctly. The process is usually far less complicated than many people fear, yet the potential rewards can be significant. The most successful retirees are often not those with the highest incomes. They are frequently the people who understand how to use the benefits, protections, and opportunities available to them. They know which forms matter, which deadlines exist, and which programs deserve attention. And that awareness can make a remarkable difference over time. There are also several smaller programs that many retirees overlook simply because the monthly savings appear modest at first glance. Yet when multiple benefits are combined, the total impact can become surprisingly meaningful. One example is assistance for communication services. Certain federal and state-supported programs may help reduce the cost of phone or internet service for qualifying individuals. While the discount itself may not seem life-changing, it represents another recurring expense that can potentially be lowered. Utility assistance programs can also provide relief for households struggling with heating and cooling costs. Energy expenses often fluctuate throughout the year, and extreme weather can place significant pressure on fixed budgets. Assistance programs exist specifically to help eligible households manage those costs. The important thing to remember is that financial stability is often built through a collection of small improvements rather than a single dramatic change. A tax reduction here, a healthcare savings program there, a utility discount somewhere else, each benefit contributes to a stronger financial foundation. Now let's return to taxes because one of the most commonly overlooked opportunities involves deductions that have existed for years. Many taxpayers over age 65 qualify for additional deductions beyond the standard deduction available to all taxpayers. These age-related adjustments can lower taxable income and reduce overall tax liability. When combined with newer tax provisions, the total reduction can become quite significant for some households. Yet many retirees continue having too much money withheld from pensions or other income sources simply because nobody ever revisited their withholding strategy after retirement. As circumstances change, tax obligations often change as well. Think about what happens when someone spends decades working under one tax situation and then transitions into retirement. Income sources shift, deductions change, eligibility for age-based benefits begins, healthcare costs evolve, property tax protections may become available. If tax withholding remains unchanged despite all those differences, there is a possibility that more money than necessary is being sent to the government throughout the year. Receiving a large refund might feel satisfying, but in many cases it simply means money was unavailable for personal use during the previous 12 months. For some retirees, adjusting withholding appropriately can improve monthly cash flow without changing overall annual income. That brings us to several advanced strategies that homeowners and families should at least be aware of, even if they are not appropriate for everyone. One example involves property tax deferral programs. In certain states, qualifying seniors may have the option to postpone payment of some property taxes under specific circumstances. The details vary widely depending on local law, and such decisions should always be reviewed carefully because they can affect future estate planning and property transfers. Nevertheless, understanding that these options exist can be important for retirees experiencing cash flow challenges despite having substantial home equity. Another area that deserves attention involves surviving spouses. When one spouse passes away, certain exemptions, benefits, or protections may require additional paperwork to continue. Families sometimes assume existing benefits automatically transfer when circumstances change. Unfortunately, assumptions can become costly. A surviving spouse who fails to complete necessary documentation may lose valuable protections that could otherwise remain available. This is particularly important regarding property-related exemptions and assessment protections in certain jurisdictions. Vehicle-related benefits are another category often ignored because each individual savings amount appears relatively small. Some states provide reduced registration fees, excise tax relief, or other vehicle-related discounts for older residents. No single discount may transform a retirement budget, but collectively these benefits reflect an important principle. Programs only create value when they are actually used. Consider a hypothetical retiree who owns a home, receives Social Security benefits, pays Medicare premiums, files annual taxes, and manages routine living expenses. If that individual misses a property tax exemption, overlooks a healthcare assistance program, fails to claim age-based deductions, and ignores available utility support, the combined financial impact can become substantial over time. None of those missed opportunities would generate warning letters. None would create penalties. Life would continue normally. Yet hundreds or even thousands of dollars could quietly disappear each year. This is why awareness matters so much. Many retirees spend years focusing on investment returns, interest rates, or market performance while overlooking simpler opportunities sitting directly in front of them. Sometimes the easiest way to improve financial security is not by earning more, but by reducing unnecessary expenses. Imagine two retirees with identical incomes. One takes advantage of available property tax protections, reviews healthcare assistance eligibility, claims all applicable deductions, and updates tax withholding when appropriate. The other never checks any of those areas. After several years, the difference between those two situations can become surprisingly large. The reason is simple. Savings compound too. Every dollar not spent unnecessarily remains available for groceries, healthcare, travel, home maintenance, emergency expenses, or future needs. Financial flexibility often comes from preserving resources rather than constantly searching for additional sources of income. The encouraging part is that many of these opportunities do not require major lifestyle changes. There is no need to move, sell a home, change investments, or completely reorganize finances. In many cases, the process begins with a phone call, a short application, or a review of existing records. That simplicity is exactly why so many people overlook them. People often expect valuable benefits to involve complex procedures or lengthy approval processes. When the solution appears too straightforward, they assume it cannot be important. Yet some of the most valuable financial decisions involve simple actions taken at the right time. A review of property tax records can reveal whether exemptions are active. A discussion with a qualified benefits counselor can identify healthcare assistance opportunities. A careful look at a tax return can confirm whether age-based deductions were applied correctly. None of these steps require extraordinary expertise. They simply require attention. If you are helping a parent, grandparent, relative, or friend navigate retirement, these conversations can be especially valuable. Many older adults assume they already know everything relevant about their finances because they have managed money responsibly for decades. But laws change, tax codes change, benefit programs evolve. New opportunities appear while existing rules are modified. Even highly organized individuals can miss important updates. That is why periodic reviews remain worthwhile regardless of income level. Whether someone lives comfortably, relies heavily on Social Security, owns substantial assets, or falls somewhere in between, checking eligibility for available programs is simply good financial practice. The goal is not to chase every possible benefit. The goal is to ensure that opportunities already available under the law are not accidentally ignored. If there is one message worth remembering, it is this: qualification does not automatically create savings. Awareness must be followed by action. A property tax exemption only works after it is filed. A healthcare assistance program only helps after enrollment. A tax deduction only reduces liability when it is properly claimed. The bridge between eligibility and savings is often just a form, an application, or a conversation. That is why reviewing these areas can be one of the most productive financial exercises a retiree undertakes. The time investment is relatively small compared to the potential long-term value. Before moving on, consider creating a simple checklist. Review property tax records. Verify applicable exemptions. Examine healthcare assistance options. Confirm age-based tax deductions. Evaluate withholding levels. Check for local and state programs that may apply to your situation. A few hours of research could potentially uncover benefits that continue delivering value for years. And perhaps most importantly, remember that claiming available benefits is not taking advantage of the system. These programs exist because lawmakers intentionally created them to address the realities of aging, retirement, healthcare costs, housing expenses, and fixed incomes. Using a benefit you legally qualify for is not a loophole. It is simply making use of provisions already built into the law. As always, specific eligibility rules vary by state, income level, household circumstances, and changing regulations. Before making financial decisions, verify current requirements through official government resources or qualified professionals familiar with your situation. The most important step is simply getting started. Ask questions, review your records, confirm what is already in place, and identify what may be missing. Because when it comes to retirement finances, the difference between paying full price and receiving available benefits is often much smaller than people think. Sometimes it is nothing more than a form waiting to be filed. USA Security Check.